Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Piedmont Realty Trust INC quarterly report. Piedmont Office Realty Trust Inc. offers a range of services including owner of high-quality office properties, manager of office properties, developer and redeveloper of office spaces, operator of office buildings, investment opportunities through its REIT, Real Estate Investment Trust portfolio. Its services are primarily focused on the Sunbelt region, with a portfolio valued at approximately $5 billion. Piedmont Realty Trust's stock price drop of over 12% in the past year can be attributed to several key financial announcements and market factors. The company's Cone 2025 earnings miss, where it reported a negative EPS of -$1.08, was a significant contributor to the decline. This was followed by increased net interest expenses due to refinancing activities in an elevated interest rate environment, which reduced rental income from property sales. The company's subsequent earnings misses in Q2 and Q3 2025, including a net loss of $13.5 million in Q3, further exacerbated the stock price drop. Additionally, S&P Global Ratings revised its outlook on Piedmont Realty Trust from stable to negative due to potential refinancing risks. These factors collectively contributed to the company's overall negative 52-week performance, with shares down 17% over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. 1. Increased rental rates from new leases, resulting in a $0.2 million increase. 2. Higher parking income due to increased utilization and transient parking, contributing to a $2.2 million increase. 3. Tenant allowance commitments increasing by $10 million. Revenue decline drivers. 1. Termination of third-party property management arrangements, leading to a $1.9 million decrease in revenue. 2. Dispositions resulting in a $1.616 million decrease in revenue. These factors have contributed significantly to the fluctuations in revenue growth or decline, with rental and tenant reimbursement revenue being a key driver on both sides. Net income and profit margins. A mixed picture. The financial summary reveals a mixed trend in net income and profit margins for the company. On one hand, net income decreased from -$11,519 to -$13,462 in the 3 months ended September 30, and from -$49,091 to -$40,374 in the 9 months ended September 30. This suggests that the company's financial performance has worsened over time. However, profit margins remained unchanged at -0.01% for both years in the 9 months ended September 30. But a closer look reveals that there are regional variations. The Atlanta segment saw an increase in profit margins due to new leases, while the Northern Virginia/Washington, D.C. segment experienced a decline due to tenant expirations and downsizing. Furthermore, same-store NOI margin decreased by 0.5% period-over-period in 2025, indicating a decline in profitability. Overall, the company's financial performance is marred by regional disparities and declining profitability, which warrants further investigation. The company's financial performance indicates a positive trend in its operating cash flow. The data from various sections of the report confirms this, with net cash provided by operating activities reaching $89,628 in 2025, and explicitly stating that operating cash flow is positive. This suggests that the company is generating sufficient funds to cover its operational expenses, indicating a healthy financial position. The company's debt level and interest expenses have undergone significant changes over time. While there are fluctuations across different periods, a general trend can be observed. The total liabilities decreased from $2,526,524 to $2,466,681, indicating a slight reduction in debt level. However, the interest expenses have remained relatively stable or decreased in some periods, with a notable exception of a significant increase on page 43. In summary, the company's debt level has decreased slightly, while its interest expenses have shown mixed results, with both decreases and increases observed across different periods. Management's outlook and strategy overview. Management is cautious about the company's outlook due to various risks and uncertainties, but remains confident in its ability to meet financial obligations. To achieve this, the company will continue to fund capital expenditures for existing projects and focus on replacing expiring leases with new or renewal leases at competitive rates. The company aims to maintain a high lease percentage by managing downtime and abatement periods effectively. It also plans to distribute at least 90% of its adjusted REIT taxable income, ensuring it remains qualified as a REIT for federal income tax purposes. Overall, management's strategy is centered around maintaining financial stability, replacing expiring leases, and distributing a significant portion of its taxable income. The company's financial summary reveals a clear commitment to shareholder value creation. Specifically, it is noted on page 36 that the company has indeed paid dividends, indicating a deliberate effort to distribute profits back to its investors. This decision demonstrates a focus on rewarding shareholders for their investment and loyalty. Concerns about inventory buildup or supply chain disruption exist due to potential risks. Development and construction delays may lead to supply chain disruptions, page 2, while geopolitical developments could negatively affect international trade, page 3. However, a decrease in inventory levels of construction in progress suggests a reduction in inventory buildup, page 5. That concludes the financial summary for Piedmont Realty Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.